Hey everyone, John Henry here, slingshotfutures.com. Today we're going to be talking about how to maximize your winning trades and cut the losses short. Now, this is something that you hear all the time. Oh yeah, trading's easy, just let the winners run and cut the losses small and piece of cake. But nobody ever really talks about how to actually do that. Now, one of the biggest problems that I think most traders have is just simply cutting the trade too early, and a lot of that comes from using limit orders to exit. Now, I'll cover more of that in a minute, but just put yourself in the shoes of what if you were able to take an extra one tick better in your favor on every trade that you took over the long run. How much of a difference would that make over the course of a week, over the course of a year? I mean, you're talking, one tick at a time on crude oil futures as an example might not be that big of a difference, but if you're constantly making an extra $10 on every trade and you do that 1,000 times, well, that adds up to be quite a bit. So what we're looking to do is not necessarily maximize the winners in unrealistic sense of, oh yeah, you're going to hold till the absolute end of the trend, because that's just not going to happen, right? That's not how the world works, unfortunately. But what we are going to talk about is how to get a little bit more out of the trade than you were maybe initially considering. So one of the ones that we're going to be taking a look at is Apple, AAPL, for those of you who are unfamiliar. Now, on Twitter, we actually talked about this setup earlier today. So if we look here, this is the post from earlier on Twitter. AAPL looking half decent for a move up here. Sellers have failed over and over and over again to get this thing going. Could be the buyer's turn. And here you can see the breakout buy point right there. Now, zoom forward a little bit, and here is the aftermath of that. Now, yay, it worked, pat on the back. I don't care about it, whether or not it worked. The part that I care about is looking at how could we take this trade, and how could we maximize our potential profit on this. So when we're looking at this trade, first of all, like we were talking about on the Twitter post, the entry point is right about there, looking for an upswing above that for buyers to come in and reverse the market back to the high of day. But once we got to the high of day, you'll notice it went quite a bit further than the high of day. So how do we stay in this? Well, there's a couple ways that we can approach this. The first way is simply by utilizing a scale out method, meaning that you buy in, it's a stock. So let's say as an example, we buy in, it's Apple too, so it's pretty expensive. Let's just say we bought in with easy numbers, 400 will give us easy math. So 400 shares of AAPL. When we reach our objective, right, so we're buying the reversal point, we're looking for the market to continue up, right, so we're looking for that breakout move to the upside. Once we get to our objective point, let's say our risk was right here, then our target would be 1-to-1 or 2-to-1 off of that risk. So what are we looking to do? Well, if you're scaling out with this methodology, then you're looking to take 75 to 90% of the position off the table. Now, because we're using 400 as the number, 75% would be 300. Again, I'm trying to keep the numbers easy here. So we take 300 shares of AAPL at 1-to-1 or 2-to-1, depending on which way you want to trade it. So that is the first option. You're still leaving a little bit on the table, and you're trying to maximize that final little bit to see if it can get running. The other way to do it would be, instead of just flat exiting and saying, you know what, I'm just going to put a limit order at my 2-to-1. Once it hits it, I'm out of the trade, good enough. You can do that, but you're cutting it off, right? You're not letting the trade actually go. You're just saying, once you hit here, I'm good, take me out of the trade. And sometimes that's what you need to do. But most of the time, you can get a little bit of extra out of it. Now, how do we get a little bit of extra out of it instead of scaling out? As an example, scaling out on futures might be a little bit more difficult. Your account might not be able to afford 4 contracts of the S&P, So we need a different way to sort of approach this so that it's universal, so you can use it on everything. Scaling out is all hunky-dory and fine, and I love doing it, but not every account can accommodate for that. So another way to do it is identifying the way that we're going to place the trade. So we know our entry point right there above, looking for a breakout move. And we have 2 different locations for our stop placement. We have the lower probability cup and handle style trade, which usually goes for a 2-to-1. And the reason, as a side note, that it's low probability is because the stop is much closer to your entry point, right? The market has less room to wiggle around and keep you in it. The higher probability of the 2 would be a stop below the lows. And this type of trade is more so looking for a 1-to-1 because you're risking more, and that trade-off is increased probability, right? You're paying with risk to increase your probability of success. That type of trade is usually going for a 1-to-1. So we know the general layout. So what we can do now is we can take a little box. I know, real real hard tools to use here. We're going to use a box calculation. We'll measure from the entry point down to the overall widest stop, and then we'll also measure the shallow ones so that we have two different types of calculations that we can work with. So this is our shallow stop right there. So these are our risk boxes, right? Our entry point down to the stop loss is what these are measuring. And because we know that this wider box is a high probability 1-to-1 type move, then we'll just take this up and we'll put the box right there. That would mean that right here is our 1-to-1. And if we take this box here, we can know that this is a 2-to-1 strategy. So there is the first, and eyeballing it, there is the second. So that is our 2-to-1 for our risk reward. Now, how do we go about really capitalizing on our gains while cutting the losses short? Well, first of all, we'll talk about the easy part. Cutting the losses short is simply the matter of not moving your stop, right? When your stop is here or your stop is here, don't let it come against you. Let's say the market starts coming back and saying, oh, I'm just going to widen my stop out a little bit. I'll give it a little bit of wiggle room. You're not doing that unless you really know what you're doing, okay? When you're moving your stop around, you're essentially invalidating the entire point that you were in the trade in the first place. The original analysis that you had on the trade said that your stop should be right there. Why are you moving it? Right? You're moving it out of emotion, more likely than not, and that is not a trading strategy. So cutting the losses small is making sure that you're leaving the stop alone. When you put the stop in, there was a reason that you put that stop there, and you need to stick by that, right? Those are your hard rules. Now, how do we maximize the gains? Well, maximizing the gains is actually fairly simple. First of all, our entry point is right here, right? So we enter in long. Theoretically, we'll just talk about theoretics here. I'm not going to go over the actual trade or anything like that. We'll just say we got in here and we're looking for the upside move. If I'm placing my stop here, that means that I'm looking for the 2-to-1 objective, which is right here. Now, when we get up into that area, I have two choices. I have the choice of simply placing a limit order to sell. Right? So you limit sell out of your position and you take your profit and you're done. You cut the trade off and that's it, right? Nothing else. Another way to approach this is to try to maximize by, instead of using a limit order, right? Don't use a limit sell. Wait for the market to get above your target area, even by just a little bit. Let the market get above your target area and then move a stop up, right? Lock that in. Because the overall trade plan is that as an objective. You do not want to give that back once the market has given it to you. But what you're doing in this way is you're locking your stop in, saying, okay, you did what I wanted you to do in the first place. Sweet, I'm happy, right? That's exactly what I wanted. But if you want to strap on the nitrous boosters and go flying another 3% higher, I'm not going to miss it. I'm giving the market a chance to move. Okay? So what we're going to do is we're going to lock a stop in once it starts getting above our trade. Right here, right? So if we look at this, it gets just above that entry point, and a lot of people probably move their stop up who utilize this style of trading, and they got tapped out. And that is okay. It's going to happen 9 out of 10 times this way, what you're seeing right here. It gets above your entry point, sweet, lock in the stop so you don't give it back, and it taps you out. That's going to happen 99% of the time. Well, we'll say 92, 93% of the time. But what the important part here is we're giving it a chance, right? We're giving it that chance to go through the moon if it wants to, because we're still in the trade. We're still holding it, and we're giving it that opportunity to go just a little bit further. Now, let's take this as a slightly different example. Let's say that I bought here, right? Same entry point. All that's the same. And we start going into our 2-to-1 objective area. Now, what I can do is I can look at this and say, okay, you know what? We've gotten into my 2-to-1 area. I no longer am willing to let this trade turn into a loss, so I'm going to lock my stop in where? Not here, because arguably it only went through it by 2 or 3 cents. Not that big of a deal. I'm going to lock my stop in at 1-to-1. Now, the reason I would do this is because I'm giving it some wiggle room, right? Now, this is where you could mix things up a little bit. Take 75% of the position off at that objective, lock that stop in really quickly like we were talking about to give it that chance, and if it whips you out, so be it. The remainder of the stop, or all of the stop, depending on how you want to trade it, is at that 1-to-1, and you're giving it that wiggle room that the market needs. The market doesn't just go in one straight direction very frequently. It usually does something like this, right? It waves its way up there, and we need to accommodate for that. So with this reversal to the upside, it starts breaking above, okay, but it only went above it 2 cents, maybe. Not that big of a deal. So we're going to look at the market context. What is it telling us that the market is doing? So we'll zoom in a little bit. As soon as we hit that 2-to-1 objective, it immediately pile drives off. Heavy, big old sell bar, right? And that's going to get a lot of people pretty nervous. But look at the follow through. Look what happens after that candle was put in. Nothing, right? The sellers were nowhere to be found. And what does that tell us? This level is profit taking, but it's not selling. It's selling in the sense of profit taking, but it's not full-hearted selling. If it were, we would see a lot more follow through from the sellers. So when it comes back to the level, what happens? Get a beautiful bear bar. Big old bear bar closing really low on itself, doesn't even trigger the sellers in. Goes back up again, another nice bear bar. Triggers the sellers in, immediately fails and goes back up to a new high. So this is giving us a huge clue. This is basically saying, hey, this up move isn't necessarily done yet. Now, what do we know? Excuse me. What do we know about the way that this chart looks? Well, we have a very strong bear bar, and we know that sellers will have sold underneath that, and those sellers are now trapped. So what are they looking to do? Well, a trapped trader is usually looking to mitigate loss. And what better way to mitigate loss than if the market comes back to break even, getting the heck out? You were wrong. You have no reason to stay in the trade anymore. So if it gives you a chance to get out with zero loss, you're probably going to take it. And that is exactly what happened here. The market comes back down, strong bear bar, finally finds follow through, only to be met with all of this buying pressure off of the sellers who are now turning into buyers and shoving the market back again. And how can we see that? Wick, 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 big wick. Finally, a big bear bar closes underneath that low, right? So this entry point, the one tick underneath this big bear bar, that's the entry point for the sellers. We get down into that area, and all those sellers start turning into buyers. That is the line in the sand, right? Right there. That's the line in the sand. We do not want to see that start breaking down. Breaks down underneath it with a big old, well, at one point it would have been a big bear bar, reversed into a giant bull bar. Not really concerned there. We finally have our first close. This is the first candle that closes underneath this level. This is where things get important. My stop, when I see something like this, is going to move up. I do not want to see that bear bar trigger in because that might mean that the sellers are taking over. So I'm moving my stop up, right? Your stop moves up, doesn't trigger in this case, luckily enough, and it bounces back up again for another run to the buyers. And once again, this level is the line in the sand. Market comes back down, closes underneath it. I do not want to see those sellers triggered in, so my stop goes just underneath that area. Don't put it right on the low. Give it a little bit of room, right? A couple cents underneath it just to allow for a potential trap. But your stop is moving in underneath there. And you'll notice what we're doing. We're ratcheting down our risk. Or in this case, we're ratcheting up how much we're going to make on the trade because this is a winning trade once our stop moved here. Now we're just trying to maximize as much as we can out of the trade. So our stop is now right there. And it starts moving back in our direction again. We're back above this level. And again, as long as this level stays intact, everything is peachy keen with this trade. We just need to keep it going. Goes back up and breaks out through a new high. Now, what do we know about market structure? Market structure generally goes in waves. It breaks out and it comes back to retest that breakout point, right? So very frequently, the market will come back and retest that area as support. So we have a new line in the sand. What do we want to see here? Well, we broke above the highs, right? So we broke above the highs really aggressively, finally rolled over. We need to see that come in as support. Here's the kicker. Does the exact same thing that it did when it was coming back for the break-even traders down here. If we look at this move, what did it do, right? All it did down here is wick, 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 finally closes outside, right? This is the first time right there that it closes below that level. So what do? We move our stop up. Stop moves in to just below that candle right there. And as long as it gets back above this area or triggers me out, doesn't matter. We're looking to hang on to it as much as possible. And you'll notice what we've done now. Our stop is above 2 to 1. Remember what we were talking about at the beginning of the video? How much better off your trading would be and your trading account would be if you could make just an extra couple ticks on every one of your winning trades. There's your extra couple ticks, and we're not done yet. Starts going back in our direction again, and now it's starting to get parabolic. Now, if you've heard me talk about parabolic moves before, this is what I would consider exhaustion. It's starting to pick up speed very, very quickly and run, and it looks like a parabolic curve, right? It starts off slow and then goes rocket shipping through the highs. In that type of situation, this move might be running out of steam. Now, in hindsight, it obviously was not running out of steam, but at that time, we don't have any of this information, right? All of this hasn't happened yet. So we have to go based on what the market is giving us. And when I see a move that looks like this, I'm thinking, okay, I might want to start thinking about getting out of this trade. Do I do it on the bull bar? No, because it might be followed up with another giant bull bar. You never know. So we got to give it our room. But I'm sure as heck not going to leave my stop way back here anymore. My stop is going to move up to underneath the moving average and underneath that big bull blow-off candle, just in case it comes back and taps it out. Because if that low of this big old exhausted bull bar gives way, I probably don't want to be in it anymore. And in this case, it comes down and taps it out. Fine. Not a big deal. Because what did we do on this trade? Our entry point was here. We were originally going to take a target here. You got another 1-to-1 out of the trade simply by giving it room and really trying to maximize that final bit of the trade, or even the whole bit of the trade. That's what I'm talking about maximizing profit. That little bit could be the difference between you being a losing trader and you being a winning trader. And it is one of the biggest things that I hear most often is that, oh man, if I would have just held on a little bit longer. Well, why didn't you? Well, because I exited at my target. There's your answer. Because you just exited, right? You didn't give it a chance to start breaking away. Now remember, 9 times out of 10, you're going to move your stop up here, right? You're going to move your stop from where it was, and you're going to put it in that 2-to-1, and it's just going to take you out. That's fine. There's nothing wrong with that because you still got the exact same trade you wanted in the first place. But the important part is that we're giving it room to run. And that way, if it does run that, 7% of the time, that little bit, that little portion that does end up breaking away can make a monstrous difference in your bottom line towards the end of the year. Something very, very important to think about, and something you might want to consider maybe adding to your trading repertoire. So that's going to do it for this one. I hope you found it useful and interesting. As always, underneath the video, click on subscribe, click on the notification bell icon so you don't miss any of the videos that we launch pretty much daily. You don't want to miss any of those. Of course, along with this is a pretty heavy topic, and there's a lot of stuff to talk about, but we covered a lot of the big stuff. If you have any questions about it, send me an email, jbrink@slingshotfutures.com. Aside from that, though, I hope you had a fantastic trading day today. I hope you had a fantastic weekend, and we will see you all back on the next one. Thanks. Bye.